everyone, and welcome to our Wealth and Wellness webinar. I'm Jennifer Polich, and this is Chrissy Riley, and we are with Coldwell Banker in Huntington Beach, California.
Our webinar series is designed to inform, educate, and empower you on how to build and maintain wealth and preserve it for generations.
Today, we will focus on estate planning, life insurance, and trusts. We're thrilled to have three very special guest speakers that will share their knowledge and expertise. First, I'd like to welcome Chris Kennison. Chris runs a financial education firm in Long Beach, California. He has worked in financial services for 8 years. Prior to this, he was a college English professor for 6 years. His mission is to educate and empower his clients through simple concepts and strategies so they can accomplish their goals and dreams that truly matter to them.
And now I'd like to welcome Miss Noelle Minto as well. Since 2003, Miss Minto has been an estate and business transactional attorney based in Orange County, California. Her practice, NM Law, represents high net worth individuals and privately held business entities based throughout the U.S. and abroad. Ms. Minto has assisted clients in crafting comprehensive estate plans and maintaining business structures to address each family's specific needs. As a seasoned estate and succession planning practitioner, Ms. Minto provides guidance and comfort to trustees and beneficiaries of the descendants after their passing and throughout the trust administration process, and assistance in transitioning family business interests. Ms. Minto was selected as Southern California Rising Star by Super Lawyers in 2008 and 2010. She speaks Italian, Spanish, and French. She sits on 2 charitable boards in Orange County and is the past chair of the business and corporate section of Orange County Bar Association. Her firm was incorporated in 2006 and is dedicated exclusively to the fields of trusts and estates and business planning.
Wow. And last but not least, we have Crista Polich, aka my sister-in-law. Crista is a survivor who learned how to turn tragedy into triumph, and she's dedicated her life to helping others prepare for the unthinkable. Crista lived for many years in an abusive relationship, and when she finally hit her breaking point and decided to leave, sadly, her husband took his own life. Crista was totally unprepared for this unthinkable situation, and she struggled to find useful resources to help her. So now, just over 2 years later, she has all the answers, and she's created those much-needed resources to help others prepare for the unthinkable. She's recently earned her certificate in professional fiduciary management for trustees and is studying to take the fiduciary license exam. She has a new book titled Turning Pain into Power that's scheduled to be released soon, and she's launched her public speaking tour to share her story and help others prepare for what she calls the 4 Ds: death, divorce, disaster, and diagnosis. We are thrilled to have Crista with us today to talk about all these things that people don't like to talk about.
Thank you, Jennifer. Thank you, Chrissy. Do I need to put this on now? Oh, wait, I don't think so. It's Zoom, I forgot. But let's get real. Talk about the unthinkable. Who would have ever thought about this in our lifetime, a global pandemic? Certainly not me. And things we don't like to talk about? Yeah, there's a lot of things we don't like to talk about. They make us uncomfortable. These unthinkable things, they make us uncomfortable to talk about. We avoid them like the plague, and we know that they are avoidable, but one is inevitable. None of us gets out of here alive, and we need to prepare for that. So going through all of the shit that I went through, and I came up with this concept of the 4 Ds: an unexpected disaster, an unexpected diagnosis, an unexpected divorce, and an unexpected death. I realized that all of these things come into play to prepare. There's a lot that you should have, main things to prepare. And sadly, I have experience with all 4 of those. In 2009, my husband and I were in Colorado, and we looked at the news the night before we left and saw that our town of La Cañada, California was about to light up in flames. All the hills above us were on fire, and we were leaving the next day. My nephew was there, and he said, "What do I do?" I said, "Just take the dog and yourself." I really had no idea what to tell him to take. I was watching the house. We came home the next day. We didn't really know what to do either. We had not prepared for anything like that. Even though we lived in the foothills of Southern California, that was unthinkable to us. Don't know why, but it was. So we decided to wait until we got the call, which we did. I ran around and I took a picture at the time with my camera, everything we owned. That was the only thing I thought to do. Take a picture of everything we owned. And we had to get out, and we took the hard drive on our computer, the dog, the kids, a change of clothes, and hope for the best. Thankfully, the wind shifted and our whole town did not burn to the ground. But I wish I had been more prepared, because it was a very scary time. And the next one is an unexpected diagnosis. Sadly, I have lived with my own chronic illness for over 33 years. That has left me disabled at times, but not enough where it has left me any kind of brain impairment. It's an inner ear disorder. But in 2012, my mom, 74 years old, vibrant, just in shape one day. And the next day, my mom had a massive stroke and was never the same person again. Has had a brain impairment. And the four of us kids, we had no idea what to do. My dad had passed away. We didn't know where any of her documents were. When we did find them, they were all over the place in boxes randomly. And we're trying to get caregivers going, because she now needs 24/7 care after she gets out of the hospital. We're trying to raise our families at the time, and then you now have this happen. And again, we were not prepared. An unexpected divorce. I was a 23-year-old girl and married the 24-year-old boy and fell in love. We had the little house, the nuclear family, a boy and a girl, moved to the big house in La Cañada, started raising our family. I was a stay-at-home mom. Never in a million years would have thought I was going to get a divorce. As the years went on, yes, there were definitely signs of some abuse that I ignored. I made him mad, or it was my fault. And I just lived my life. And then in 2012, my husband lost his job, and he was never the same person again. He went through a major depression, and the abuse continued to get worse and worse and worse. And I really didn't know what to do or where to turn. And I knew I just felt in my heart that I needed to stay because of my children, and also because of things that he had said to me. I was not going to be easy for me if I did leave. So I felt very stuck. And as the years went on, I knew I was going to stick it out till my kids were graduated from high school. The summer after my last child graduated from high school, that summer I finally consulted a divorce attorney after a major event that we went through. And I was scared to death that summer of him, of all of it. I had no idea what it cost to run our household. I was pretty clueless. I had my head in the sand. I let him kind of do everything because he was a finance guy and he was our CPA, and I just let him do it. And I admit, I come from experience now. I had my head in the sand, and I didn't give a shit. I didn't want to know about it. I just let him handle it. And that was really silly, and in hindsight. So after she went to college, we had agreed to get a divorce, separate and get a divorce. And 3.5 weeks later, on November 14th, 2018, I said goodbye to him for what was the last time. And 6 hours later, I got a call that he jumped off the building and took his own life. And I never saw him again. and then now you're alone. So there's the unexpected death. And these are things that none of us want to even think are going to happen to us. And then you're alone, but then you have to grieve, and then your children are there, and you need to take care of them. And I will tell you, in the 3 weeks between the day of his death and the celebration of life, you have so many people, including my fabulous sister-in-law right there, and friends and family, and they were there for us. And I talk about all the things about this in my book, what you can do to help other people when they have to go through things like this, and all the things and the ways people helped us. But then that celebration of life is over, and Monday morning, wait a second, I have to do this all by myself now. And it was really, really difficult. And your brain, I call it cotton candy brain. Your brain, it's like your brain is like not plastic, it's cardboard, not cardboard. Is it cardboard? Your brain's like the cardboard that you hold with the cotton candy. And then everyone is telling you from the day they die, and I'm sure Noelle can understand this too, from the day the person dies, they're giving you so much information, and it's kind of sticking like cotton candy, but then it's crystallizing and leaving because you don't remember it. So I'm going to share just a brief checklist of things, and I know Chris and Noelle have way more of the expert part to talk about, but things that help me and things that I think that you should, if you don't have these things together, you need to get them together, and I'm happy to help you down the road, but I'm just going to share some things with you to take away to help you be more prepared. Well, here, I have to tell you, clearly, it took a lot of courage for me to finally fess up and deal with all of my shit and to finally leave. And I found this a couple months after my kids and I went to get Chinese food, and this was my fortune. And I thought, okay, I am moving forward, but this, for some reason that day was really helpful to me. And I really wanted I had my feet in quicksand for a long time. And this really helped me before Paul died and after to just kind of go, there's no one else. I have to, it's only me now. So that was just a little tidbit for you. And here's a little checklist I came up with. So this was, you need a trust, will, and an estate plan. We had a trust attorney, but after Paul died, I realized he had retired. I know Noelle's going to talk in depth about this. We did not revisit our trust, and so the one that we had in 2018, the one from 2005, and we revisited when Paul died, was not anything that we needed, and that was something that caused me a lot of pain and havoc, and frankly, money that I had to pay for after he died to change some things. Be specific in your trust and your will. You don't want family squabbles about things. And as far as specific wishes for in case of your death, it was really, I cremated Paul. I knew the man for 28 years and I didn't know if he wanted to be cremated. And I still feel terrible about it to this day that I did not know this for him. So this is something that you should talk about. Mm-hmm. Assets, liabilities, and insurance. I did not know all of our assets till I met with a divorce attorney. I really didn't know all of our liabilities and expenses. I didn't know how they were all paid. I found out when I was getting some things together behind Paul's back that we had some loans that I didn't know about. And I know, Noelle, you could help me out with this when you give your talk, but there were 2 loans in Paul's name over $150,000. And in California, even if you have a trust, that they go to probate. And one of them was able to retroactively go in my trust name, so I didn't have to deal with that. But I had no idea that that was something I was going to have to deal with. Know all of your insurance. I know Chris is talking about life insurance. Know the amount of your life insurance. I will tell you from personal experience, that was one of the best experiences that I had, was filling out the claim for Paul's life insurance. I thought I did it wrong because it was too easy. And when I checked it and checked it and checked it. And 3 weeks later, when the check came via FedEx envelope, my son and I were jumping up and down. I was so happy about that. So that was one good experience for sure. This was a credit card that Paul had that I had no idea was even out there. So I found out later, I found all these expenses that I didn't know about. So again, you should know these things. Investments and taxes, you should obviously have a financial advisor, CPA. Know all of your investments and have knowledge of your tax returns. I admit, again, my head was in the sand. I did not know all of these things. Our financial advisor was Paul's friend. Paul was our CPA. I was in effect sleeping with my CPA, and I just signed the tax return because he told me to. Never looked at it. When I had to find it, it was on Paul's computer, and I was very confused. So know these things, at least have knowledge of them. Your passwords and logins, you should know them all, yours and your spouse's, your parents, even your children, your adult children. You should have access to these. Keep them safely or use an app. Remember to update them often when passwords change. Noelle could probably talk about this. Digital asset assignment was an addendum that I added to my trust agreement after Paul died, which is, she can, I'm sure, talk to you about it, but a legal addendum that allows fiduciaries and beneficiaries access to your digital accounts. Because I had a hard time getting into Paul's Gmail account. I still to this day have not gotten into his Gmail account. I did not know the password to his phone. I tried last fall to send to Google his death certificate. I still have not heard from them. It's been almost 9 months. So you should know these things and know where they are and have access to them, and make sure you tell your beneficiaries those things as well. Location of important documents. Find a safe place and keep them organized. Have one copy and keep one with a close family member in case of something else. There are many digital platforms now and paper storage options. I am in the process myself of putting all my things into a digital platform called Everplans, and I am happy to help people with that. You notify your beneficiaries where they are in case of something like my mom's situation, because we didn't know where all these things were. And these were our lovely organized files, but not really. And these were this was just crap everywhere, which was actually all over our garage. The only thing that was organized was our trust was in a notebook and some investments were in a notebook. These were all over the place. And then I put them in here. And I have another box too, but I didn't take a picture of that. And this is even 8 months after Paul died. Still things, even in the trash, filled to the brim with things that I had to take care of and deal with. So I just wanted to share my story, share some of the things that I dealt with, and I want to just encourage you to know how important it is to prepare. I bring insight and experience. I don't bring expertise. The experts are an invaluable resource and were to me as well. I do know that it helps to prepare, because preparation can bring peace, not only for you, but for your loved ones. I want to help you prepare. I would love to talk to you. Please reach out to me, call me, text me. I would love to meet with you anytime, talk to you. Our circumstances may be different, but our stories are the same. Thank you.
Thank you so much, Crista. Amazing, informative information as well. I'm stirring over here thinking about what I need to do.
Oh my gosh.
When I get home, I'm getting married, so now I'm like, okay, I need to be prepared before the wedding. So I'm like, probably far too prepared, but you can never be too prepared.
Yeah,
right?
I mean, and I just updated my trust with Noelle, and it hadn't been done since 2004. So yeah. You've inspired me, Crista, so thank you for that.
So next up, we have Mr. Chris Kennison here to talk to us about life insurance. So Chris, let's start off with, how does someone figure out what type of life insurance they need and how much do they need?
So first of all, Crista, thank you so much just for sharing that story, because I know it's not easy. You could say it gets easier, but it's still difficult. So I appreciate that. And Jennifer and Chrissy, just thanks for having me, on the webinar with you guys. So the short version, right, is that I have sat with so many families, right, and from all different walks of life, from single moms who have $50 in their bank accounts to clients who have millions of dollars of assets. And there's always something about financial literacy that they have no idea They have no concept of it all. One of them is actually life insurance. I sit with so many families who will go through their finances and they have a life insurance policy. And I'm like, great. Well, like, what kind is it? And they're like, I don't know. I was like, okay, well, what's the death benefit? I think it's $250,000, right? Like Krista's shaking her head like she knows about this because she went through that experience, right? And then I asked this question: why specifically did you get X type of policy with Y amount of life insurance? And they almost 99% of the time have no idea why they bought the thing. And I was like, that's fascinating to me that no one sat down with you to really just educate you about what is life insurance, why are we supposed to have it, and how do we calculate it, and all that sort of stuff. So I'll jump in. I have some things I'll go over just about the basics of life insurance. But I'll tell a little bit about my story too before I jump in, because I always say this: when you ask kids what they want to be when they grow up, they always have really big goals and dreams. They say things like, I want to be an astronaut, or I want to be the president, or I want to be something noble, police officer, firefighter, something like that. If you asked me what I wanted to be when I grew up, I did not say, I want to work in the financial industry and wear a suit and teach people about money. Right? Wasn't my biggest goal and dream in life. I actually wanted to be a professional baseball player, and I was relatively good. I played all the way through college. It wasn't good enough to get drafted. And I was an English major, and I had some professors who really encouraged me to get my master's degree so I could be an English professor. And I actually started my career as what's called an adjunct professor. And a lot of people don't know this. There's a difference between tenured professors and adjunct professors. To keep it short, tenured professors basically have job protection for life. Adjunct professors are considered part-time labor. And I had to teach 6 classes at 4 different colleges just to get enough work.
Wow.
And so I was financially trying to figure out how to be an adult. And I had a girlfriend, who's now my beautiful wife, Amy, who Jennifer knows. And we were just like, how do we learn how to save money? Like, where do we go? Right? We were trying to read books. We were trying to figure it all out. And we had met an associate who works with the firm that I'm now associated with. And we became clients and started figuring out how to pay off our student loans and save money and things like life insurance. But then they actually said, hey, why don't you work with us part-time? Like, you can just build your own schedule. And I was like, okay, well, I'd like to not have to teach 6 classes a semester now. And that's when I really fell in love with it, because again, just family after family after family, it didn't matter their financial situation. There was something they didn't know about financial literacy. So I'll go ahead and I'll share my screen right now, and I'll bring up just a little bit about the basics of life insurance. So again, I have a short amount of time. We're just going to go over the basics of life insurance, like what it is, the different types and stuff like that. The question that Chrissy had asked was, how does someone figure out what type of life insurance to have or how much they need? So many different types, so many different kinds, so many different options, okay? There's a basic, I call it napkin math, because you can literally do it on the back of a napkin. It's something called the DIME method. We call it insurable need. And so for someone, you're looking at D stands for how much debt they have, whether it's credit card debt, student loan debt, could be debt, joint debt, could be individual debt, right? So imagine that I have a partner and my partner has $50,000 of student loans. Part of my life insurance policy, if I pass away, is to help my partner basically become debt-free, so she doesn't have to worry about the student loans or the credit cards or something like that. I stands for income for survivorship, and kind of the standard with the insurance industry is about 10 years of income replacement. So again, God forbid I passed away, part of my life insurance is supposed to give 10 years of income to my partner or my spouse. M stands for mortgage. So especially for people who want to buy homes or want to get rental properties or something like that, part of a life insurance policy is actually supposed to pay off the mortgage. So that way, if they pass away, the house is free and clear. They don't have to worry about selling maybe when the market's not right. They don't have to worry about missing mortgage payments and getting behind on that. They now don't have to worry about their mortgage. And then E stands for mostly educational expenses. But I also put it in estate taxes because I know Noelle is an expert about that. When it comes to educational expenses, you can have some of it set aside to, this is a college fund. This is $50,000 that we use for a college fund for our child. So God forbid I pass away, at least we know they can go to whatever college they want. Okay. Now at the bottom, it actually says that life insurance death benefits are tax-free. That's actually one of the biggest things about them, is that whatever the death benefit is that comes to the family, they do not have to pay taxes on that. The only exception is possibly estate taxes, which again, I'm not the expert on that. You have to do it a specific way. But what some people will do is they'll make sure they have an insurance policy in place to minimize their estate taxes depending on what plan they set up. So literally anybody can sit down and within about 5 to 10 minutes figure out how much life insurance they actually need, just based on this basic simple thing called the dime method. Okay. When it comes to the different types though, this is where it gets, for a lack of a better term, confusing. Because there's so many different types, so many different companies, nobody really knows how they all work. It basically breaks down into two categories. You have term insurance and you have permanent insurance, which is also known as like cash value, okay? So term policies basically are a temporary policy. You get it for a certain term of time, 10 years, 20 years, 30 years, something like that. But that policy is going to expire after that term. And if you want to renew it, it's going to be at a higher premium. In other words, if I'm 30 today and I want to get a $100,000 policy, it doesn't cost the same if I was 60 to get that same $100,000 policy. Okay. It doesn't have any savings or cash value component. It is just a death benefit that someone is basically paying a premium for. Okay. The premium though is lower for coverage compared to a permanent policy. Okay. So that's kind of the good news for a lot of people, is that they can get more death benefit at a lower cost. And the premium is fixed. So let's say I get a policy for 10 years and based on that policy, I pay $50 a month. It will be $50 a month for that whole 10-year period. Here's what's interesting though, is that nowadays some policies come with something called living benefits, right? And Crista kind of mentioned this with disaster, death, divorce, and diagnosis, where God forbid someone gets a significant diagnosis, okay? Some term policies now, not the old ones, but newer ones, they'll actually have something called living benefits. What does that mean? The insurance company actually allows people access to the death benefit, not their own money, right? They take the death benefit and they can use it for terminal or chronic or critical illnesses. Wow. Because God forbid someone does have a diagnosis like cancer. Mm-hmm. Chances are they're going to have to pay for medical or replace some income because maybe their benefits don't cover all that. Maybe their disability doesn't replace all their income, right? So they won't be able to go to work. They won't be able to pay medical bills or something like that. They can actually use some of the term policy instead of touching their emergency fund, instead of touching retirement accounts, instead of something like that. Okay.
Wow.
Yeah, it's crazy, right? And people are like, I didn't know that. Well, I'm like, well, let's look at our phones. I have an iPhone. I don't even have the newest iPhone. I have like an iPhone 9 or 10 or something like that. Every single year they update the iPhone. Yep. If you look at an iPhone 10 years ago, it's almost like a completely different phone. Absolutely. So we upgrade our phones, but we don't update our financial plans.
Right.
That's crazy to me, but that's just because we don't know. There's no literacy. Okay. So when it comes to more like permanent or cash value policies, these are like the biggest 5 that you're going to see. I don't think there's any others. Maybe there are, but there's basically a whole life policy, a variable life policy, a universal life policy, a variable universal life policy, and an index universal life policy. Okay. Yes. Very, very confusing. Sorry, Jennifer. What did you say?
I said very confusing.
Yeah. Okay. So here's kind of how I explain it to people. You know how you have family members that are not, they're part of your family, but they're not blood relatives, but they share the same last name. Okay. But they're the weird side of the family. Okay. So you're like, we're nothing like each other. We have the same name, but we're not the same. Okay. And just any of you who are watching on the webinar and you're like, I don't have a weird side of the family. You are the weird side of the family. Everyone else talks about you, just so you know. Right? Obviously kidding, totally a joke. But so here's how they're all a little bit different, even though they're all permanent policies. Okay. So a whole life policy, again, it's a permanent policy. So what does that mean? As long as the policy is in force, the coverage doesn't terminate. Doesn't matter if you're 40, 50, 60, 80 years old, if you're paying the premiums and it's in force, the death benefit will pay out to the family. So it's not a short term. It's literally, that's why they call it whole life, because you have it for your whole life. Okay. Now the premium though pays for a death benefit, but also a portion of it goes into a cash value account that grows based on dividends. This is the biggest difference between permanent policies, is how the money grows. So a whole life policy, the company that issues it basically pays its policyholders based on dividends of how the company performs. Okay. And the premiums are fixed. So what does that mean? You're going to pay the same monthly premium or annual premium. That doesn't change. Every month, every year, the same premium. Okay. A variable life policy is a little bit different. It's like a whole life contract, but the premium pays for the death benefit, but the cash value grows based on a choice of investment. So the policy owner can actually choose different accounts where the money would grow. It's not based on dividends. Okay, so again, a little bit different, but again, the premiums are fixed. So same monthly premium, same annual premium, that's not going to change. Okay, now what starts to get different is something called universal life. Again, it's a permanent policy, but the premium pays for a death benefit and the cash value grows based on interest rates. So if interest rates are high, higher rate of return. If interest rates are low, lower rate of return. But one of the biggest differences is it's actually a flexible premium type of account. What does that mean? That means that you don't have to put in the same amount of money every single month. So for instance, let's say that the policy has a minimum of $1,000 and a maximum of $5,000. The client can kind of choose on a year-to-year basis to save more or save less. They have a lot more flexibility with how they fund the account. Right? You don't have to be paying into your 80s if you design it the right way. Okay. Then you have variable universal life. Okay. Again, permanent policy, but the premium pays for a death benefit and the cash value grows based on market returns from what they call sub accounts. To translate that, it's basically mutual funds. So again, we get to choose as the policy owner, we get to choose, or we have an advisor help us choose how we want the money to grow. Okay. That means that the money can go up, but the money can also go down because it's based on the market, right? So if the investments we chose are growing, the money grows up. If the investments we chose are going down, our money's going down. But again, it's also flexible premium. So you can kind of put in more, put in less, depending on what you want to do. The last form is something called indexed universal life. Okay. Same permanent policy, same idea where the premium pays for the death benefit, but the money, the cash value grows based on a mirrored market-like indexed account. The most common one is something called the S&P 500. Okay. Some people have heard of that. Some people haven't. The S&P 500 is a list of the 500 largest publicly traded companies in the United States. Okay. So it's all the names we've heard of. It's the Apples, Walmarts, Coca-Cola, Google, stuff like that. What's different though is that the account actually uses a cap and floor strategy. What does that mean? The floor might be 0%. Like I put an example of 15% and 0%. So if the S&P 500 goes negative 10, negative 20%, the floor is 0 and they don't lose any money. But they will cap the upside. So in other words, if the stock market did 20 or 25%, they're only going to get up to that 15% cap. And then if it's in the middle, if it was like 10%, then they get the 10%. So they minimize the downside, but they're going to cap the upside. Okay. And then again, also flexible premium. So you can put in more money, you can put in less money. It depends on how you want to do it. Okay. So then the question becomes this. Okay. So what policy should I have, Chris?
Exactly.
Okay.
Yeah.
Okay. Here's the thing. This is just me speaking. Personal finance is personal. It's not one size fits all. Right? So what happens? Well, some people just get a term policy for their whole coverage. Mm-hmm. Right? If they need $500,000, they get a term policy for $500,000. Well, some people actually just get a permanent policy for their whole coverage. Some people do a combination of term and permanent. It really is like client by client, case by case, person by person, because again, like this is what I tell people when I sit with them. Nobody's going to care more about your money than you do. Not me, not a financial advisor, not a life insurance agent, not a money manager. Even if they're an amazing person, at the end of the day, no one's going to care more about your money than you. But oftentimes people just don't have the education and know what their options are to figure out how should I do it. Should I do it one way? Should I do another? Should I do a combo? So unfortunately, I can't tell people. I'm like, I don't know. You tell me what you care about. You tell me what your life is like. You tell me what you want your goals and dreams to be, and you have to build it to accomplish those things. Right. So I wish I had more time. I know we wanted to keep it short, and I probably even went over what I was supposed to. But I did put some personal info in here. So people have my cell phone number. That's my personal email account, right? So if people want to email me that way. I know some people like to do social media now, so you can follow me there. You can find me on LinkedIn. But those are probably the 4 best places if people do want to get in touch with me, just to ask questions or sit down and figure it out from there.
Wow, that was so much information. I had no idea there were all those types of policies. I thought there were 2.
And honestly, I've had my life insurance policy for probably 5 years, and I didn't understand what I had until right now. I truly did not understand that, like, I chose the right one. Now I'm like, oh my gosh, I want to go get this other one, So thank you. Like, literally, that you explained it in such an easy way that I think all of us and our viewers alike can understand something that is so complex and so important. So thank you for shedding light on life insurance.
Yeah, and Chris, also, I just want to mention that I know you also handle a bunch of other topics when it comes to financial literacy. So you're an expert in so many different things, but that was a lot to cover, and we appreciate it. And we'll have you back again to talk about the next subjects.
Absolutely.
Chris, you can answer this question. Obviously, my husband, I know there's the confusion about if you get life insurance if someone commits suicide. And I can tell you that, yes, I did get life insurance because he had it over 2 years. I think that's correct, right, Chris?
So different companies will have different, basically what they call a suicide clause, where, because think about it from the company standpoint. Okay. And again, this is no joke. This is just, I'm being like direct. Okay. If someone decides I'm going to take my life, I've made that decision, and they're like, well, let me go get $1 million life insurance policy, and then the next week I take my life. Obviously, they weren't doing it in good faith. So insurance companies have that suicide clause in place to make sure that as long as it's past that period, whether in your case 2 years or 5 years, whatever, different companies do it differently. Yes, even if someone does take their life, it's possible that their policy will still pay out.
Great.
Okay, but not all companies offer it?
It's basically pretty standard on every company's policy. They just have different terms of time.
Okay.
So it could be 2 years, it could be 3, it could be 4. It just depends on the company who's issuing the policy.
Okay.
Great to know. Thank you, Crista, for asking that question.
Yeah, I know there is a big misconception around that. So thank you for clarifying that. Next, I'd like to talk to Noelle Minto and ask her some questions about trusts. And specifically, Noelle, I'd like to know, can you tell me about probate? What is probate and how do you avoid it? What are the costs? Can we start there?
Absolutely. Yes. Thanks for having me. And Crista, thanks for sharing your story, because, I sit across a marble table and tell people in this hypothetical sense what could happen to them if they don't do good planning. But, when somebody shares the story from living in those shoes, walking a mile in those shoes, it just has a whole different meaning where people really try and start to understand and appreciate, what it's like to administer a trust while you're grieving, and how do you pick up the pieces and move forward. So thanks for sharing that. And I have to say, Chris, there were a couple of things I learned from you in terms of the back of napkin, which I call lawyer math. I think lawyers only do back of napkin math. So thanks for sharing that and giving us sort of those tips on that dime method. I think that's such a simplified way for people to have a really basic understanding of what kind of insurance they need. So to answer your question, even my lawyer clients always ask very basic questions about trust and estate. So they might be excellent practitioners when it comes to figuring out how litigation works and how to file things in court. But most lawyers even do not understand what the difference is between a will and a trust and what a probate is. So today I'm really going to just spend about 5 or 10 minutes going over the basics. And I am sharing my screen if everybody can see that. I'll go ahead and put up a couple of slides just to walk you through the basics of estate planning and what probate is and how to avoid it really is the goal here. So First, let's talk about what a trust is versus what a will is. And a trust is a living document, meaning it's something you sign, and it's a contract between you, the person who's funding the trust, which is referred to as the trustor, and the trustee, who is the person who's managing whatever it is you're funding the trust with. And then the third essential element of creating a trust is just to have something in there, right? So it could be any one asset, or it could be 10 million assets. But that's the essential elements of creating a trust. And why it's so valuable versus a will is because it's an effective document while you're alive, as well as when you die. So it not just manages things in the event of death, but also in the event of disability. And it can have a lot of other provisions in there along the way, right? And so it's really a way to continue to control things, and not just while they're put in trust while you're living, but even after you're gone. Because a will, by contrast, is not a valid document until you die, because it can be changed, it can be ripped up. And so a will is really just saying, here's where I want my money to go. Okay, but it can't really dictate specifics in terms of how it's going to go. So if I have a 15-year-old child and I have a will, essentially that 15-year-old child, when they turn 18, will just get a bucket of money, no strings attached. Probably not the best financial plan. I don't know about your 18-year-olds or 15-year-olds, but I don't think it's a wise choice, and it's typically sort of asking for trouble. A trust, by contrast, can really set up some specifics, right? As even when you're 15, the trustee can provide money, not directly perhaps to the 15-year-old, but for the benefit of the 15-year-old. And they can specify, I want this spent for school. I want this to help them buy a first car. I want to help them pay for their first wedding, right? So all of these parameters can be designed in a trust, whereas a will, it's really just saying, here's where I want it to go. There are a few exceptions with wills. There are wills that can have testamentary trust and all that, but by and large, a trust is going to be the instrument that gives you all of those bells and whistles, and that's effective not just when you die, but as soon as you sign it and fund it. And so the other great distinction between a will and a trust is, even if you put pen to paper or you hire an attorney to do a will, guess what? You're still going to probate. You are still going to have to go through a court process. And I'll tell you, it was a bad process before, but since COVID, it has gotten worse. And it's frankly the least funded department of the court system, because they figure probate is about money. Everything else is more important, right? Criminal trials are going to get precedent. All of the resources are getting directed away from probate and into the other departments that they consider to be more urgent. Family law, child support, right? These are critical issues. Unfortunately, California looks at probate court and says, it's just people waiting for their money. They can wait longer. So we've got a simple will that says, I give everything to my best friend of 25 years to, and here's where I want it to go. You're going to take almost 2 years to get a court order to have it delivered to that person. And the fees are another huge issue. A trust, I always tell people, if they don't do a trust and they've got significant assets, they're being penny wise and pound foolish, because it's less than typically a tenth, and usually I'd say even a 20th of the cost to put together a trust and administer a trust than it is to go through probate. And we'll go through that in a second, but that's just basically the rough math and the difference between a trust and a will and what probate is. So again, here's just some bullet points of what it is that a trust provides that a will does not, right? And again, keep in mind, when you have a will, it's a public process. So the documents about your family and about the assets they're inheriting is all out there for the public to see. So creditors, et cetera, can all find you, not just now, but 20 years in the future. Okay, so there are circumstances where people don't need a will. And by the way, this more than 150,000, this number's just changed. It's changed to $166,000 if you know it's now 2021. So this number has allowed for a little bit more money to pass without having to do a probate. So, if you look at the bottom line here, I say, look, if you're a college-aged adult, just turned 18, maybe you just got your very first job, you don't really have much, all you have is student loans, right? And you're glad to get rid of those. Then maybe you can get away with a will, and it's probably appropriate for you to do a will. Likewise, people at the other end of the spectrum, right? People who are on a fixed income, they really don't have much left. Maybe they're living with a child, they're living, perhaps in an apartment, and they only have a bank account or two. Great, those people should do a will. It's probably not worth them to spend a couple of $1,000s to do a complete estate plan. But everybody else really should be, in all likelihood, in California, having a trust. If you have real property, you need a trust, right? Unless it's a $20,000 real property. And again, in California, good luck finding that. And if you do, let me know where it is. And then, I don't know, do you want me to talk a little bit about powers of attorney?
Sure. Yeah.
So, a lot of times people come to me and they'll say, look, I don't have any estate planning documents. What is it that I need, right? And I always tell people, you always start with the very basics. So I don't care if you're Bill Gates or, again, if you're that newly married couple, right? There are some documents that are just essential for everybody. And the trust we talked about, we always have something called a pour-over will. And the reason we have a pour-over will is if you go back to that slide of having more than what is now $166,000, a pour-over will just says anything I forgot to put in my trust, I want it to go there when I die. So if you did forget a bank account, right, or a CD you inherited from your grandmother, a pour-over will virtually scoops that out of your name at death and puts it into your trust. You are just not allowed to do that with a full probate process if you exceed $166,000. So the other documents, in addition to the trust and the pour-over will, which is different than a last will and testament, are powers of attorney. So we've got two key documents, and I always tell people, look, if you want to be penny wise and pound foolish and not spend any time sitting down with lawyers or doing your estate plan, the two documents you really have no excuse not to have at your disposal are the healthcare directive and a durable power of attorney. They cost a couple $100s, and they will save your family so much heartache in the event of some sort of injury or disability. They keep you out of probate court in that if somebody becomes incapacitated, you cannot manage assets without this document unless you have, you guessed it, court approval, right, where you're now appointed as their conservator. And again, that is a ridiculously slow process and extremely stressful on a family who's already dealing with a disabled relative, right, who might be in the hospital or, need to have surgical decisions made. So by all means, these two documents need to be prepared and need to be provided to your family so that if there is an emergency, they can step in action immediately and help you, which is what they want to do. So again, the durable power of attorney is a financial document, and then the healthcare directive is a healthcare document. So you can have different people with different strengths, right? My sister can make my healthcare decisions, but she can't balance a checkbook. Then make her the healthcare agent, and then make somebody else the durable power of attorney agent, which is the financial power of attorney. So they can go into your bank and say, here's the document saying they're disabled. And we have special ways to do that to keep you out of court and keep it simple as well. But you can instantly go in within a day and have access to their bank accounts, online access to pay bills, etc. And that brings up a really important point that Crista talked about, and one other thing that is becoming more and more problematic, and that's digital asset management. Because people go, okay, yeah, that's my iTunes songs. Not exactly, right? Every single company out there, Google, Amazon, they all have different policies And it's a nightmare to really determine which policies each of these companies have, which documents they want to see. There are now third-party companies we're seeing come and really organize this. So if you have older parents, or if you're a single person, signing on to a company like that, that basically has done all that legwork for you. I think they charge like $50 a year or something like that. It's an excellent way to alleviate that pressure from somebody who's stepping in trying to help pay bills and so on. So Crista, my heart went out to you when you felt, I mean, all these months later and you still don't have access to email or precious pictures or, you know, online access. Bitcoin, right, is another one. So all sorts of digital asset issues coming up that people need to be cognizant of. So that's it. I do have some information on asset titling, and you know, if you want to take a look at this slide or email me, I'd be glad to provide this slide, because there's so many misconceptions out there. Or people think they have a great estate plan, they think they got things covered, and then the titling is wrong. And I'll tell you, a trust isn't worth anything if you haven't funded it properly. And then a lot of people that have foreign roots they think they found a cheater way around, you know, getting a trust, and they'll say, well, I put so-and-so on title. Well, come talk to me and I'll tell you all the reasons not to do it that way, because they think that they're, again, saving time, saving money, dealing with less paperwork. Oh, all I needed to do was a deed, but it has all kinds of tax ramifications and other ramifications that people need to be aware of.
Thank you so much, Noelle. Quick question based off that last slide, if you don't mind. I see your share can still be in your trust with tenants in common. So if you purchase an investment property with a friend or a family member, and it's currently in, you know, each other's names, and you create a trust, can you transfer that into the trust's name if the other person is still in their own personal name?
Absolutely. That's the beautiful thing about being tenants in common, is you really have full reign over your share, right? So if you're a 33% owner, that can change 10 ways to Sunday. Now, if you have some sort of restrictive covenants, right, with a property agreement, then potentially you've agreed not to do that. However, even in those situations, there's typically an exemption for one's own personal trust, right, where you can transfer it to your trust without having written authorization from the other owners.
Okay, great. Thank you.
Yeah, that's a great question.
That's
so much knowledge. Oh my
yeah,
gosh, so much.
Yeah.
So much to go over.
That's just great. And you know, one of the things that Noelle, I talked to you about recently was, and I didn't know this, and I probably should have, but you know, I was asking, you know, I have some things that are titled under my trust name. I have them under my trust name, but then I was like, now do I have to update my actual trust with those, to add those things to my trust every time I purchase something? And I think that the answer, and I'll let you answer, but I think it was that they're automatically added to the trust.
Well, so it depends. We give our clients, and again, this isn't every estate planning firm, but we give our clients a document called Certification of Trust, which is essentially the titling instructions, right? Saying, I'm the trustee, here's the name of the trust, here's the date of the trust, the tax ID, all the basic titling elements. And we give our clients an original certified version of that. So when they do acquire new assets, they hand that document over, whether it be to escrow or to the new bank, and then everything can be directly titled into the trust so that you're not chasing it down the road, right, trying to get it from your name into the trust name. Now, what I think we were talking about is if you have, for example, a corporation, right, or something you've already put into the trust, and you add assets under that entity, or even accounts under that entity, that's all going to already be under the trust because the corporate name is under the trust or the LLC name is under the trust. So there are certain things that because they're under a different umbrella, you don't have to bother retitling them.
Okay, I see. Great. Wow, you guys, so much information.
Thank you so much.
I learned so much.
Definitely.
I just, Crista, thank you so much for sharing everything. And I know you have a lot more to share. And you know, I can't wait to come and see you speaking at different events. And Chris, I'm coming to see you about so many things, starting with life insurance. And Noelle, I'm already working with you on my trust. So you guys are all invaluable in my life, and I appreciate you being here today. And thank you for sharing.
Thank you so much, everyone. Your knowledge is just unbelievable. We can't wait to share it with our future webinars as well and have you guys on in the future, because I think your expertise, extends far beyond what we discussed today. There's so many topics that we can discuss. So to all of our viewers, make sure to send a message or comment below with any questions for future webinars that we're going to have. You can reach out to each individual expert as well. They shared their information with us. So thank you for sharing your personal information so our viewers can go and reach out to you guys directly as well. So thank you so much again. And we can't wait to see you next time.
Thanks for having us, everybody.
Bye, everyone.
Bye.